Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Okay, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Back with my semi-regular discussion around mortgages. I don't know any property investor that likes having mortgages. It's in many ways the utility we need to keep growing and developing portfolios as a gateway to provide growth, wealth creation, whatever your objectives are investing in property. But those that are better utilising finance typically do better in mortgage and mortgage investing. Real estate investing. I've seen it time and time again. So I catch up with the crew over at Finni Mortgages every now and again, just check in, see what's going on, keep my sense and pulse of the market, understanding of what the banks are up to and what interest rates are doing as a way to telegraph maybe the way in which the economy is heading. Joining me back in the studio, their head broker. Are you a head broker, Eva Loisance?
Yeah, take that.
Yes, the head broker. Yeah.
Yeah.
Do you just do podcasts now and you don't write loans anymore?
Yeah. I just listen and do podcasts. No, I do a lot of loans still.
Yeah. So we occasionally bring a guest along with you, or you bring a guest in with you, and this is really the professional relationships that you have across the spectrum of real estate investing, you know, buyers agents and accountants and all these stuff. And you do a lot of work with InvestorKit, who for many of you know, you're probably not familiar with this business. They have their own sort of podcast shows on this podcast network, the Property Investment Podcast Network, Property Nerds, which a lot of you may have tuned into it. And it would be remiss of me not to say this InvestorKit actually for 2 years in a row has been the Buyers Agency of the Year at the National Awards for Real Estate, the REB Awards. So you brought Arjun Paliwal into the studio. I haven't seen Arjun for a little while. He's been out and about doing stuff.
Yeah, it's been a while. I've been through a bit of craziness on the personal front and on the health front. So gotten through those challenges and here we are in the flesh, literally the first time since that all took place.
Really? God.
Yeah.
So life's good?
Life's good. Life's good. I'm on the mend, feeling much better and back in action.
That's cool. So you guys have Finni and InvestorKit some common clients. Is that so this is really how a buyer's agent works with a finance broker, mortgage broker, and how you go about sort of delivering on probably the briefs that Arjun gives his clients on sourcing. How's that working? Is that right?
I think when I first contacted you, Arjun, I realized we had a lot of clients in common, even though we didn't directly refer those clients to each other. So clearly we had some common grounds, alignment in our business. And it's like, well, we can probably do better. And that's how it started.
You could probably do better. Have you done better?
For our clients. Yes.
Yeah.
So that's how it started, really.
Yeah.
And often does it work, a client, someone will come to you even and say, I'm thinking about investing in property, can I sort of a mortgage, and they haven't spoken to a buyer's agent yet? Does it normally go that way? Or is it, I've been working with my buyer's agent and we've worked with them and they've worked out my strategy is this, therefore I'm going down this pathway, therefore on these sort of loans. Is one more common than the other?
It happened both ways. When people come for finance without any plans on how they're going to buy property and what property they're going to buy, always at least plant the seed of you might want to think about a buyer's agent.
Yeah.
Give them some names, refer if they want to. And Arjun is obviously one of the buyer's agent we would send our clients to, knowing they're going to be looked after. And the other way around is people have buyer's agent and they know exactly what they need to buy and need the finance to get that sorted.
So do you like working out finance on the basis of the person has a deliberate strategy of an asset they're looking to buy rather than, hey, can you give me a pre-approval for 800 grand? And you'll go, what's it for? And I'll go, I don't know, I just want to pre-approve for 800 grand. Do you like doing it for something specific? Is it better? It's easier?
Yeah, so that's right. It's never good to be short-sighted. I just want finance for one property and then you buy this property and you realize that's not what you needed. It doesn't fit your plan, doesn't fit your future goals. So long-term strategy, and you can't go 20 years down the track, but you need to have some sort of strategies as to first property needs to be that price range, second property needs to be there for that reason. Either is it growth, is it yield, is it, a lot of different reasons. So if there's no strategies, it's never going to work.
It's never going to work. And you probably see a lot of problems. You try and unravel portfolios and fix it up. And this comes back to the purpose why you invest in property, but then what are the particular assets that you put into your portfolio need to have a purpose, and you do property investment for a reason. For a lot of people, it might be to have a more comfortable retirement. For other people, it might be for long-term generational asset planning and stuff. But you need to have a view towards legacy planning, as in what are you going to do with your portfolio at a point in time. And while a lot of the times you don't think about that when you're starting off buying your first investment property, the best investors at least have some view of what that may look like, or how you go about navigating those first couple of purposes, so your legacy planning is better because you have better assets. There's a good reason why most Australian property investors own two properties, because they usually buy the wrong properties first, and therefore their legacy is probably got to sell these because we can't hold on to them, and therefore there's problem. Welcome back, Phil Tarrant from Spark Property Investment, chatting with Eva at Finni and Arjun at InvestorKit, who work together to help their clients out doing good stuff. Is legacy planning, Arjun, more of a strategy on a buyer's agent side, or is there a sort of financial component or finance aspect of that as well?
I think it depends on how holistic you want to be. I think if you're going to be a pro property and you feel most comfortable with that asset class, then it's likely, in my opinion, should sit best with that portfolio planner being the buyer's agent. And that's when you're able to start to go, okay, what is the end goal you're trying to build? And this is something I'm surprised very few people know, even though they've considered investing. People jump in going, I can borrow, I have money, Australian property good, get started. And so whilst that's great in terms of an action and a behavior to get started and doing something positive, if you're not going to have that end goal and reverse engineer, you end up being pretty stuck. And you also end up making decisions that have shiny object syndrome across it. Oh, I saw this ad. Oh, I saw my friend did this. I was about to do this, but my auntie said that. Uncle at the barbecue said this. And so this is a recurring theme when you don't have a plan, where when you have a plan, you look around everywhere and you go, hey, that's just a bit of noise here. It's a bit of noise here. Oh, you should buy this. Well, why? My property plan tells me I don't need to buy it till maybe year 3. And I'm going, well. So that's where we do come in. But if someone goes, I really want to be across multiple asset classes, then it's a combination of us, the right finance professional, Eva, then actually having a financial planner. Because that financial planner can go, hey, let's do things on super, let's do things on stock, let's actually give the advice to get you to the end goal. But from a legacy perspective, Phil, I'm really surprised when I see how many people don't have that end in mind. And if they do have one, it's a really corny thing that they heard and they just thought they'd run with it. 10 in 10 years.
Yes, I hear that actually.
FIRE.
Fire.
Financially independent, retire early or something.
Yeah.
Which is great as a concept, but what does that mean to you? By when? By how much? Or someone constantly hears the word that psychologically, the old, I want a Mustang, and then you see a Mustang keep going by and it's a red Mustang and you keep going, well, I never saw these before. Someone says 100K passive, the next mate says 100K passive, and you all of a sudden go, 100K passive is my goal. Okay, wait, is that including inflation? Is that adjusted to when? Is that 100 enough? What are you on now? Oh, you're on 80. Okay, well, is 100 enough then? Maybe you can in for a lower target. Or no, you're on 250. Do you really, can you get off the cheese and wines and you come down from the 250 down to your 100? Probably not. So I think the main thing is planning is super important.
Yeah, and planning is sometimes difficult because you're planning in many ways in the unknowns. You don't know what direction your life may take. You might not be married. You might end up getting married. You might have kids. You might have heaps of kids. They might go to private school. There's a lot of things that you've got to plan for a future which in many ways is not set in stone. And how you choose to navigate or manufacture that future, some will be connected in with your approach to wealth and wealth creation. Do most of your client base is it normally a couple of people, like a couple? Or is it individuals who are doing stuff like how do most people go down this journey with someone else sort of glued at the hip?
Yeah, the majority are couples.
Yeah, okay.
I find it's like a bit of a yin and yang in a relationship. One person is measured, numbers, driven in terms of the goals, the end outcome, and then the other person's dragged along with the journey. It's like, no, come through. We're going to go chat to these guys.
So you're a marriage counsellor as much as
a little bit of both.
Have you ever
happens.
seen a kick-off in a meeting where there's been a fight and stuff? Does that happen?
Not in the meeting.
Yeah.
But I have become a bit of a body language expert of late, thanks to what we do. And so you see the shrugs, you see the eyes, you see someone look at each other.
Really, you get like the
little
roll
things, right?
Do you ever get a phone call after and go, can you tell him that this is the right thing to do?
I've had a couple. I'm not going to pretend here and say I haven't had that.
Yeah.
But I think the more sensible ones, they do it in a subtle way. They're like, could you just run through what you shared with us on the last call, but just specifically on these 3 points? And I'm like sitting there, I'm like, totally, we'll do that. And we do that. But in my head, I'm like, you perfectly understood it all. I know you did. You're doing it again to make sure it goes through to your husband because he didn't quite get this one, right? And that was the scenario I can remember vividly. And that was exactly it. She called me up afterwards. She goes, he didn't get it. Now he gets it. Thank you.
Yeah.
And I'm like, okay, makes sense.
The interpreter of, because I imagine it's, and it's good investing with someone else. Like it's good to do something in collaboration with someone else because you have a shared outcome, right? Shared outcomes, particularly when it comes to property investment for a couple, whatever your version of a couple is, it's irrelevant. Typically means a shared experience of that outcome. And hopefully you want to keep these couples together so they both get the benefits of it. It's when you pull these things apart where it's an issue. But, an objective shared is normally an objective that's realised, right? Because you've got accountability to each other as well as yourself, which is really cool. But, planning in an environment where you might be thinking about a 30 or a 40-year journey as a property investor, it's hard to think about what that, chapter 8, chapter 9 is going to be when you're at chapter 1. So what's the best way to go about building a portfolio with legacy planning in place? It's got to come back to asset selection, I would imagine, as a core at the start.
I think even before asset, what we want to try and do is we know the long-term history of property in Australia, right? 90% of local government areas over the last 25 years have achieved more than 5% compounding.
Yep.
And the only 10% that didn't were not houses in terms of the asset type or extremely singular economy, small locations with no statistical reliable data.
Yep.
And so that means everywhere did apart from those. And
so essentially you can guarantee 5% compounding.
Yeah. So there's a 40+ year metric sitting there that you can go, I know we can't perfectly assume that the past is forever, but I'm not going to bet against 40 years of data. And so now that I know that, let me put the asset selection, the perfect research all aside, and let's just focus on the basics of inflation, time, borrowing capacity, cash, age, and the number of properties you have versus the number of properties you need to get there. So this is all part of a property plan, and this is where Eve and I collaborate a fair bit, that we can create a plan, but there's no point creating that plan if you can't see at least a couple of the steps that Eva and the team can then go, hey, this one's okay for finance, we can get that. Yep, we can get you the next one, we can borrow this much. And now the plan starts becoming reality when the two collab together. And so I think once we get to that point, then it becomes hey, trust the journey, because some people look at their income today and they think it's going to be their income forever. Like we just came off the back of the last few quarters, in data terms, one of the best periods of wage growth in Australia. And so what that means is that number you think you're on today isn't your borrowing capacity forever. And also the number you're looking at today is at the time of some of the highest interest rates in recent times. And so that high interest rate, you're also looking at that from a moment of time saying, that's my borrowing capacity, I can't do any more. So the idea is firstly to go asset type, markets, research aside, what do we need, reverse engineer, where can we get to on a finance front? And then from that perspective, take one step at a time and realize your situation is going to change as time goes on.
And most people's situation changes for the positive, or is it normally the negative for a period of time?
Majority are the positive,
yeah.
Right? You get periods of times where negative, wife loses a job, husband loses a job, extra kids come in that they weren't expecting, you know what I mean?
But it normalizes again usually.
It normalizes. And also one thing I want to call out, Phil, and this is something that many people forget, is high income earners, when they get to say a 150 to 250K income as an example, there are fewer positions in the world of corporates or the world of businesses where across Australia there's a frequency of jobs at 300K, 400K, 500K. The numbers get less and less as those income brackets go up of how many jobs out there have that. But one thing I always respectfully challenge some clients on is I go, hey, you're on 200 now. I know sometimes those leaps at work, the next can be quite distant in your mind, and they make their whole life's plan thinking they're going to be in the same journey forever. You're in this position because you've got certain skills that have got you here. You're earning what you earn because you've earned the stripes, you've worked your butt off in your career, you've gotten some opportunities, or heck, if you want to even be humble and say you've gotten lucky, sure, say you've gotten lucky. But the main thing is those skills don't just disappear overnight. And as time goes on, it's unlikely you'll be in the same income forever.
Yeah.
And it's now that we're 6 years in as a business, I can go back talking to some clients in 2018 who thought that was going to be their income forever. And as crazy as it sounds, they're on double that now. Because what I find is that trajectories don't just stop. You don't become less skilled. You don't become less hungry. You don't have less opportunities. They go with the world grows. It happens and it builds it around you. And so I've learned that the most in 6 years in business, that do not look at your situation today as if it's your situation forever. It constantly changes, and majority of the times it's for better. And you're able to tell clients now that, hey, that goal that you first had in 2018, you're there now. Now what do we want to do it for? Oh, look, I'm good, Arj. Don't want to buy anymore. Great. That's your legacy built. Or in some cases, it's like, no, I want to take it to the next level.
Makes a lot of sense. So it's easier either to be a better mortgage broker if someone's got a plan.
Yeah. Yeah, of course.
How many people would have a detailed plan that you sort of come across?
If they come from
I know when you've done my mortgage, I'm just, give me a
yeah,
mortgage.
but you know enough to have the plan in your head. I don't need to, I guess, know it.
So you know, so you're just assuming I have a plan.
Yeah, just assume you have a plan. Maybe not.
Yeah.
Just talk to Arjun.
Yeah, maybe.
No, a lot of people that would start like first-time investors, they have no plan. They just don't know. They just, as you said, they're here at the barbecue or their friend has done it, and they just want to get onto the rat race of buying property. And I hear a lot, 10 in 10 years. That's
slogans.
That's
Phil's
like
got a tattoo of that, I think.
10 in 10 years.
10 in 10.
Yeah, I hear that all the time. And I've got clients that bought probably 6 in the last 4 years, and they're just like, oh, let's do 10 before, next year or something. And they don't even know why. It's just like a competition.
I think we did a thing once, 10 in 10. I think we bought in the Smart Property Investment Portal, we bought about, I'm going to say
10 in 10 months.
18 in maybe 5 years or somewhere other. I can't remember what it was. It was probably accelerated. But 10 in 10.
Yeah. So there's like those goals that really don't align with what they can do. But also
it's a bit of a myth that now, because, a decade ago when you could buy houses in Mount Druitt for, I don't know, a couple of $100,000, 250 grand, to actually buy 10 investment grade properties today, it's pretty hard. It's pretty hard going. The numbers have changed. The numbers becoming a lot less irrelevant as property prices have got a lot more expensive, connected with people's incomes, I would say.
But on that point, Phil and Eva, with the whole 10 and 10, the thing is, you also the value of each property, the rent of each property is also higher than 10 years ago.
Yeah.
So technically, you don't need 10 anymore.
You don't.
Right? We've conducted so many portfolio plans, and on that note, we see, okay, if someone did say, for just basic numbers' sake, have 4 investment properties, had a family home, and that family home in 20 years from now gets downsized, that downsized tax-free sale based on that family home
only enough
will start to actually clear your debts on your investment properties. And then you've got super on the side that hasn't even been considered. So you'd be surprised how many families, when they map out their goals, 4 gets them there. But the difference is, if you've got a 20-year plan, you can't buy 4 across the 20 years. You probably need to buy 4 in the 5 years. Because once you condense your buying window, you have a long enough time for your holding to actually compound growth enough so that growth in debts and rent are where you want them to be.
Yeah.
Because I find every time I look at a plan under 20 years, I'm usually doing one of 3 things. Number 1 is they have a lot of equity, a good amount of borrowing capacity, and we're going into aggressive buying and commercial properties.
Yep.
Number 2 is we're aggressive buying and selling down a bunch, all within 10, 15 years. Or number 3 is their monthly savings rate is so high that they're able to not only have their purchases made, but still put money into offset really quickly so the balances get offset in time. That's not every family. That's a very unique cohort of people. And so I always think that 20 years is the sweet spot, and that's when we talk about legacy planning. It's not about...
So 20 years is enough to do some damage, is it?
Yeah, I think 20 years is that sweet spot because you get enough time to buy. Typically, I don't want to buy for clients for longer than 3 to 7 years, right? So I'd be surprised if some of my 2018 clients kept buying with me, over the next decade.
And it's a really important point, Arjun, because most of the narrative around property investment is about buying property. But
Yes.
when we're talking about legacy planning, like there is a very clear stage, which is accumulation, but there's two other very important parts of wealth creation through property. It's maturation, if you want to call that, or consolidation, and then it's extracting the wealth effect from that. Welcome back, Phil Tarrant, chatting with Arjun from InvestorKit and Finni's Eva. So everyone gets obsessed with buying property, and that's what you hear mainly. But you just said then the buying window for you and your clients is somewhere between 3 and
7 years.
7 years,
Yeah.
which is really condensed when you think of maybe potentially a 40-year journey as a property investor. So you do the heavy lifting at the front end, which is buying the assets, but then moving forward as you go about consolidating them, it's about how do you prepare for that last phase, which is realising that. So consolidation is the most important aspect of, I would say, all property investment. That's really effective management of it. That's when you're tinkering with rents all the time and make sure your mortgages are the right mortgages, what you have. So it's sort of, maybe repricing mortgages or even refinancing mortgages and shifting potentially if you accelerated your buying early on from second-tier banks or non-banks into, first-tier banks, getting better rates. Like consolidation is often the most overlooked aspect of property investment, but it's probably where the real rubber hits the road, whether or not you're going to be successful or not. Do you spend a lot of time in that space with your clients?
Yeah, we do. I think we'll spend more as time goes on because as our business,
legacy clients.
Absolutely. As our business goes from 6 to 10 to 20 years, from that legacy aspect, we're going to see it a lot more. But the thing you've touched on, like, me, Phil, I'm a data guy. So when I look at that data, the first thing is that 3 to 7 year rule has come up because the majority of our clients are in their 30s and 40s.
Yep.
So when you're in your 30s and 40s, that 3 to 7 years of acquisition, another 15 to 20 of holding, and suddenly you're either having a very successful late 50s or early 60s, or you're actually getting into it in your early 50s and you're beating the retirement clock, right? And so you feel like a little bit younger when you start to enjoy the fruits of your labor. So that's the first part. But the second part is debt is our friend, being for me and Eva. We can help you leverage it, grow a portfolio. Eva can help you get the right lending to unlock the portfolio. But then debt is not our friend when you actually want a passive income.
Yeah.
Right? Offset debt can be your friend, but debt is not your friend when you're trying to get a passive income. So the idea here is that fall in love with it to unlock the assets you can build, the actual diversity in the number of properties, and the rental income you can scale. But no, you're not meant to have that time when you get to consolidation. So in consolidation, it's a really important point. There's probably 3 call-outs I want to make. The family home being downsized is by far the most powerful consolidation tool in Australian property. You've got a non-income producing asset sold, replaced with another non-income producing asset. So there's no rent that you're losing. Because many people forget that when you buy 4, you think it's going to be la-di-da, sell 1, keep 3 debt-free. You just killed 25% of your rental income. Did you factor that?
Yeah.
Most don't. And also when you're buying 4 investments, it's usually one of those 4 or 2 of those 4 aren't as pricey as the other 2 because you're trying to squeeze through them as you got to your borrowing capacity. So you're not selling the most expensive assets either. With your family home, you're probably going to take a fair bit of pride in that when you get to it. It's going to be something to fit a fair few kids if that's part of your life journey. And as a result, you'll have a large asset that's compounding over time. And when you downsize, history's in your favor. Units don't perform as well as houses do over the last 40 years in Australia. So you're actually not getting chased by something that's growing at the same rate. You're getting chased by something that's growing at a smaller rate. So you now consolidate debt-free and have a non-income producing sold with another non-income producing. Second is you've got an asset base that you haven't had to catch. You're not catching houses. You're having units. You can fall back on it and feel good. And then the third is it's tax-free money to clear debts that you shouldn't have used your after-tax income through your life paying off.
Yeah.
Your after-tax income through your life should have been focused on your home. Let your investment sit there and let that gearing, the deduction take place, and look to clear your debts from your home. So that's one aspect of consolidation people don't realize.
Yeah, it's a really important point. And there's a period where consolidation comes in a sunsetting, right? Where, say you go down that pathway and you downsize a family home, you leverage the equity in that property to pay off whatever debt still might be connected with it. And a lot of people might not have any debt on their family home. That means they can use whatever's left to buy a new joint and then also pay down investment properties. That's great. So that's on the basis then that your investment properties are income generators for you.
Correct.
Right? that might not be enough for a lot of people, right? So you actually need to start thinking about, well, I need to liquidate those properties. And that's when you start liquidating investment properties where you do have tax consequences, right? So legacy planning is really connected with the structure in which you hold your assets, and therefore really smart planning alongside your accountant to make sure at that point in time when you start divesting assets, whatever that looks like, because you're not going to be borrowing against them to leverage the equity, right? You can't. So they either sit there and generate income, that's great, and then hopefully your estate planning allows those properties to transition to other, generations. Again, you need to make sure structurally that you're set up really, really well. But if you've got to start selling off stuff because you want dough, well, there's an expectation around tax. So you've got to make sure you structure that properly. I think, again, not considered significantly enough at the front end of people's investing journeys because they're so far away. They just don't think about it.
Yeah, and this is where you're seeing a lot of stuff, Eva, where you're seeing different structures these days, right?
Yeah, we just talked about trust offline.
Yeah.
It's becoming a huge thing. But I guess, I can't give advice as a broker. I see a lot of things being done. I know what it means, and you're the same. You see a lot of different structures, but you can't give advice either.
Correct.
But people, I think, are reluctant to get into an accountant or financial planner because it's a huge upfront cost when they're like, oh, I just can buy the property in my name. Like, I don't need. So then they get to the second and then they get stuck. And I think it's 80% of investors are stuck at 2 properties, right?
Yeah.
It's huge. The number's huge.
Yeah, I think with the whole trust thing, like me and you were talking about it earlier, and what we find, so to your point, team, Phil, building the team.
Yeah.
Right, if you've got a team around you, that accountant's going to realize, hey, are you going to consolidate some of these properties? Because maybe if we're in a trust, yes, you might not get the negative gearing individual deductions today, but your negative gearing deductions will build up over time. And once you sell that asset, you'll have some offset that you can have happen. And then also your distribution of that sale might go into more tax effective environments, which is where your accountant comes in to give you advice. Now, there's a few things on consolidation. One is the structure. Second is your vehicles of purchase. So people sometimes purchase residential property and think that's it. The idea here is that residential can transition to commercial over time. And we've seen that happen for many clients, where we see residential build for those clients who've been with us for the whole 6 years, and we start to get to commercial because they can envision that when they do a downsize or when they sell off a growth asset, it starts to actually pay off their commercial, and that becomes the cash flow machine. So that becomes the second point. The third point, you're never going to hear a property person say this. You can actually also go no property. And what I mean by that is there are other vehicles that might have higher yields. There are other vehicles that might be a lot more liquid. And whilst I'm pro-property, property can also be a weak cash flow tool, but it can be a great growth tool.
Yeah, and a lot of times these things need to run in parallel with each other. And any financial planner will say, it's really funny because financial planners, my experience with financial planners, a lot of them aren't big on, property. They're big on other asset classes, and property people are like, we're property people, we don't touch other asset classes. I know some people with massive portfolios that go, I don't even touch any other asset classes because I don't know it, I don't understand it. I can control better outcomes, blah, 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 right? So it's good to have some level of diversification. I was saying, to your point, there's other asset classes which are a lot more liquid and some of them yield better. And you only need to look what goes on with the ASX, right? Or trading equities or other asset classes or investment vehicles. It makes sense to have a wider view than just property. But you must see it all the time where people just go, no, property. No, I'm just property.
My environment is very heavy property, and Eva's the same as well, right?
The leverage, you can't.
Exactly. And I think like Australia's had such property success, so it becomes front of mind. But funnily enough, we're not property crazy as a country, even though it feels like it. Because remember, only 35% of our properties are investment properties, so it's not like the whole country's full of it. But the main thing to point out, though, is when people see property portfolios, they will grow over time because of that leverage aspect. But imagine holding an asset and you've held it pretty nicely for 20, 30, 40 years now. At some point in the future, it might not be the prettiest home still.
Yeah.
You know what I mean? It might start crumbling in some areas. It might start have a few things. And this is where consolidation can have some strategic avenues where you let someone else look at the renovations or the improvements and you move it to an asset that, like stocks or something, that's very liquid. It sits there. But the main thing is I've always seen property as that growth tool. and then it gives you options. And that option could be hold the properties, transition to commercial, sell it off, and go off to stocks. Or don't do what the silly folks do. They sell it off and they have a great trip in Vegas or something crazy like that, right?
And it happened. So there's a true connection between sort of strategic outcomes and asset selection and the process of holding your property with having the right mortgages. Like that you can't do one without the other.
Absolutely. And that's why that collaboration, it just allows us to get to the point of structure meets leverage meets plan and asset selection.
Yeah.
That's the whole picture coming together.
It's good. Thanks for coming in, Arjun. I always enjoy catching up.
It's been a minute. It's good to see you in the flesh
I
again.
heard you were out with the team recently. You went, where'd you go? I don't know. You went and had lunch with them somewhere. And
yeah, we had a good catch up in the city. Circular Quay.
Circular Quay.
Good views out that way.
Yeah,
and
that's
caught up on life, caught up on everything that's happened. Always good to see the familiar faces.
Yeah, it's good. It's all, keep at it, keep plugging away, mate. And I hear InvestorKit's going well, and I'm always hearing people singing your praises out and about. So,
thank you. Yeah, we've had some pretty special results for clients, and I think when you have that, it just compounds, and people tell people it's like the old local business, not so local anymore because the locals made it not so local, right? They told everyone, they spread the word.
I know what you mean. Go on, Eva.
Thank you.
Thanks. You guys got capacity at the moment, run up with Chrissy. I know everyone goes, I want to sort this out before Christmas.
Yeah,
I might even get another loan in the system before Christmas.
There's definitely some FOMO at the moment happening. I think people before they think the rates are going to drop, we need to get in. So it's been really busy. But
it's such a thing, right? And you're looking at auction results, and I keep sort of abreast of the market. It's like, there's lots of stock out. There's more stock than buyers at the moment. It's certainly a buyer's market. Yep. There's not a seller's market for sure. So no doubt you and your crew at Arjun are capitalising on that.
A few
I'm talking
cities
about
are showing
Sydney
that.
at the moment.
Sydney for sure. Melbourne for sure is another
yeah.
one. I think just most of New South Wales and Victoria are seeing that position. And exactly, do you want the growth? Not the areas there for short term.
Yeah.
Do you want the negotiation opportunity and the ability to go against the grain? Those are the two states.
So that's where some of the upside is. You might not get accelerated capital growth immediately, but you're getting your manufacturing equity in the way, and because you're probably buying the opportunity less than what it would have been 6 months ago.
Absolutely. And also you're not forced into the stock. What I mean by that is in tight markets, you compromise on how comfortable you feel. You compromise on the bedrooms, the bathrooms, the reno potential, because you're like, every month is 2% gone, 1% gone. In these markets, you have the luxury. Take your choice.
Choice is good. So if you want to get, but it's funny. Everyone starts talking about it and people think it's a thing that you got to buy now before interest rates start going up because it's going to go crazy. And I see Albo bought a house. Did we do his home loan?
But I heard he didn't need much of a loan.
No. I wonder who did Albo. I want to. If anyone knows, let me know who did Albo. Good on him. Buying that,
absolutely.
I was a bit annoyed with some of the sort of off script, a little bit annoyed with some of the commentary coming out of that. Like going, you want your Prime Minister to be successful.
Yeah.
It's a $4 and a bit million house on the Central Coast. You go any place closer to the city, it's $2 to $3 million. Like, leave the guy alone. Let him get on with it. Anywhere else in the world, he'd be celebrated for doing well.
And there's two big call-outs there, Phil. I'm with you. There's two parts, right? No one wants any leader of any organization or the country living in scarcity.
Yeah.
Right? So I'm not saying a scarcity is any house, right? Sure, it's not scarce if you're having $1 million home. But what I'm trying to say is that they should have aspirations. They should have goals. They should be able to chase them because it flows on to how you are as a leader.
Yeah.
Right? If I'm struggling as a leader of my company, I'm not going to be able to have any time for leadership that's unselfish or thinking as my company should. If I'm doing well, I'm going to feel in a mental state. I'm going to feel comfortable and I'm going to deliver what I can. But that aside, I want to share one thing. The biggest mistake people think is people who buy properties like that, people think that they're debted up to the head buying stuff like that. People think they've got the borrowing capacity because we know his salaries. His salaries aren't all that.
So it's $500,000, I think.
Right. So his salary is not all that on a $4.5 million scheme. It's great in terms of Australians, don't get me wrong. But it's not all that when you're buying $4 or $5 million properties because they're expensive. Yeah. Right. So the key thing to learn is that's something really important in Australia where a lot of people actually make their cash from assets held in the past. And so when they go and sell, upsize, downsize, whatever it may be, they're not attacking the new homes with a lot of loans. But there's this misconception that happens where people see a price tag and they immediately assume 80% loan, 90% loan. Remember, Australia as a country has $11 trillion in housing, just over $2 trillion in loans. So a lot of the country...
So what's our LVR as a nation?
Just over 25% roughly or around there. So that means whenever people transact in Australia, PEXA releases a lot of data on this, not a lot of people are out there getting frenzies
There's a lot of
debt.
cash buyers.
A lot of cash buyers.
I think a quarter of cash buyers.
So I
if
think
PEXA comes out
when
there.
people see Albo's thing, like I'm telling you right now, his salary technically isn't enough to go and get the 80-90% loans for that plus many more properties. It's likely the fact that he's made money elsewhere in an asset, sold it, and he's getting something with not much
And again,
dividend.
you can't compare different people's pathway in property. And Albo, I think, is late 50s, maybe he's nearly 60.
That's right.
You know, he's one of the longest serving MPs we've got currently in Parliament. He's worked bloody hard for, like, irrespective of politics.
Correct.
He's worked hard for many, many years and committed his life to serving the Australian public.
Correct.
You know, and a lot of people would think, well, he hasn't done or whatever. Like, I'm putting politics aside. Mate, that's okay. You know, he's worked hard and he's hopefully he's done the right legacy plan and made the right choices along the way. You know, he's invested in property and he's probably cultivated some equity and he's moving some dough around and he's buying a nice home.
The truth
Absolutely.
is, your clients
marry
could do that
his, you know.
eventually.
Yeah,
If
look, I mean,
anyone could do that if they plan well. At 20, at 50, they can do that.
Yeah, it's a lot of time. Like you said, it's a lot of time of work. And look, speaking of putting politics aside, I'm a Kiwi, so I have no clue, no craps about what's happening in the politics here in Australia. I'm here and I'm just like, I don't know what happens, but I know
because
hard
this is where you
work.
make money. You can't make money in New Zealand, I'm told. Yes, this you buy Australian property.
we use it all on milk and bread. So it's a bit tough there.
Yeah, but if I know some folks in the Labor Party do tune into this because they want to keep across on housing and stuff. So if Albo wants to come on and talk to us about property, I'd happily entertain it because it's great to see how all Aussies, irrespective of what you do and how you do it, can go and sort of do all right in property. And I hope he enjoys it up there on the beach there at Copacabana. Good on him.
Absolutely. No, get after it. Do your work. Do your grind. And it's not loans everywhere, as I explained. It's a lot of hard work and assets owned over time.
Assets over time. And your crew, Finni.com.au is best place to track you down.
Yep.
Get in before Christmas, the Christmas rush.
Christmas rush, yep. We still have time. There's still, 6 weeks, 8 weeks?
Yeah. Can you do a loan in 6 weeks?
Yeah. You
Can't do mine in 6 weeks.
That's on you. That's all on you, Phil, for not getting what we need.
Go on. You borrowing at the moment?
Me, I'm a bit to myself of late.
Yeah.
I've off the crazy life event. I've been focusing on business and things, but we bought our big forever home in February.
That's right.
So since then, we've just been just chilling back a bit. But we'll be back in the market.
You happy? That's good.
Best thing ever. And the whole reason is that it's like 11 of us family, generational living all together.
Proper compound.
Proper.
Old school.
Look, I always said to my mates and family, I couldn't care about the house at all. I just don't. Like I'm in one room, head down, going at it. The main thing is that just having 11 of your family members, stepmom, stepsister, mother-in-law, sister-in-law,
you're still
dad,
friendly. You're not living in a tent in the backyard yet.
So the power of that area is there's 2 houses on the block.
Yeah.
So one block for the in-laws and the parents, and one block for me, my brother.
Are they all getting on?
Stuff.
I
wouldn't. It's okay.
Don't ask.
Don't ask, Phil.
Yeah. Mate, if I was you, I'd be speaking to the council and getting a DA in there for another little. Put a couple of those little tiny homes out there, mate. Give everyone their own thing.
Put it this way: if you're up for another reality show to join your TV series, call it the Paliwals. Come on over, and we'll have a lot of drama.
Jesus, all right, that's good. Good times. Well, thanks for coming, crew. That's always good to see you. Thanks for tuning in, everyone. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ. That's how you get their info. Track us down there, Smart Property Investment on the Instagram, which people seem to like. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.